Sven Weber, you launched the SharesPost 100 fund last spring. It's had a nice run since then, from 20 to 25. But before we talk about the performance, tell me a bit about the fund. You invest in pre-IPO companies. How do you do it?
Well, the name of the fund is the program of the fund. We identify with extensive analytics research what we believe are the SharesPost 100 most interesting late-stage venture-backed companies. We look and search for the best companies of the best individual venture capitalists. And then we look to invest in it via the SharesPost trading system, which is a joint venture together with NASDAQ. And we also buy directly working with the companies to build an exposure across as many names as possible in this list of 100.
And how are you different from GSV Capital or First Hand Tech? Because they do what you do as well. They look for pre-IPO companies, buy their shares. How do you compete with them?
Yeah, there are two differences. One is investment strategy. We disclose our 100 list. Investors can look up in what kind of names they're getting exposure. We have a clear 80% investment policy that 80% of the capital needs to be deployed across these 100 names. Other funds, like you mentioned, they give a strategy that is very vague in a sense to say we really want to get in these or these names. The other structure is they are BDCs. They raise all the money at once and then have to deploy the money very, very fast, and you get a time exposure of that time. Whereas we take the money in over a period of 3 years, so you get a nice sense about our good markets and bad markets.
And what are the best holdings in your fund right now? What do you have the most confidence in? You have Jawbone, you have Kabam, you have a lot of high-profile names in there that might not ever go public, right?
Yeah. So that's like asking what's your favorite kid. So every kid and every portfolio company goes through different phases. But you mentioned a couple like Kabam is right now our largest holding. We were lucky that Alibaba invested after we invested about $120 million into the company. That gives confidence. We have that in other companies too, where follow-on investments come in. Oracle just announced acquiring one of the other portfolio companies, Datalogics. So we see first success, although the investment strategy is clearly we invest with a 2 to 3 year investment horizon. We are not going in just months before an exit.
Well, in those cases, you get a cash if there's a takeout. But what if they do go public? What do you do with the shares then?
So existing investors typically have a 180-day lockup, which we have to honor. But after the lockup, we sell. The fund is not in the business of holding public stock. The fund is in the business to provide the realized capital gains as distribution and take the cost back to reinvest in interesting companies.
And then finally, do you need a Facebook in order to get people excited, or an Alibaba about investing in pre-IPO companies? Because there's not a juggernaut coming along that's going to really get anyone excited, at least on the near-term horizon.
Yeah. So in venture capital and also late-stage venture capital, the best investors did best because they were continuously in the market. It's very hard to now say what is the Facebook in 3 years from now, which is our investment horizon. So it's better to build a diversified portfolio across different sectors, pick the sector leaders in each of them, and see these companies mature. I'm sure 1 or 2 of these will be a potential next Facebook, but it's very hard to say 3 years before they do so.
All right. Thanks a lot, Sven.
Yeah, thank you. Thank you.
Thank you for watching The Street.